In things that have completely shocked me to my core, Tom Cruise is 63 and Bill Ackman's actual name is William. And since changing your name is cool now, welcome to CNBC television.
I'm going to talk about money because we are the business network. All that
I'll take
sort of
over
stuff.
from here, Nate. You can bounce. Take a coffee break, Nate. And by coffee break, I mean bring me my coffee.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very mixed day across the board, except here in discretionary. That was led by the restaurant segment, McDonald's, reporting a double miss, but the US segment doing a lot better than the market actually thought. McDonald's was up 3.5% today. Restaurants gained. What also helped the gains was stuff like Amazon up 0.5% and Tesla up 5.84% because there was some news regarding FSD and the improvements that Elon is making with FSD, specifically off-road. We also saw gains in real estate. Very good day today. Basic materials, utilities, healthcare as well. Certain parts of financials. I know my portfolio is doing really well. Visa up 1.3%, but credit services running up ahead of some of the earnings we have this week and just powering some of the losses they've seen over the last couple of weeks. And then banks did take it on the chin. However, the big boys were actually fairly upbeat. Tesla, Amazon, green. Google, Meta were flat and green. Google really held it in there for comm services. Apple barely up on the day. Microsoft up 0.62% on today. And then the biggest semiconductors were down here today, Nvidia, AVGO, but the smaller ones actually did do very, very well after onsemi was up 11%, reported great earnings. And I think that really goes to show, again, probably going to see some of the same earnings dynamics. Nvidia, AVGO were the big earnings winners over the last 18 months. We're going to see some of that money rotate into the smaller names. And very similar to last week, we actually saw technology stocks get sold off here, but not quite as brutally as they did, down 0.5%. Discretionary was the best performing sector, up 1.6%. Communication services up 0.9%. Then it was real estate, utilities, materials, consumer staples, healthcare, and we had a mix of cyclicals, growth, rate sensitive, cost of capital sectors that were upbeat, and this really ensured that the S&P 500 remained pretty flat on today. We saw a slight gain, up 0.08% for the S&P 500, and it's kind of crazy to see that industrials, financials, and technology are some of the biggest sectors. They were all red today. The S&P 500 was really flat, so it really goes to show that if these are red and the wider market is green, can actually still get a slightly positive day. Again, that just goes to show how big some of these sectors are, but that these sectors also hold a bit of strength in them. But it was a brutal day for small cap names. Smalls were down 1.2% in the value side, 1.1% in the core side, 1% in the growth side. We saw growth and core outperform here in the large space, mostly driven by the mega caps, and then value was pretty much flat on the day. I don't know why they make a zero tile red. It should really be like gray, but it is what it is. And then mid caps actually relatively stable. And it's very easy to see the dynamics at play. Right now for the Russell, we're just digesting gains. This is healthy, especially after, from a peak to trough, 14% rally in like 15 trading sessions, kind of nuts. So, if you did miss the go here on the IWM, I would probably get in at the 216, 217 level right here. Seems like a good spot to buy before we make the push back to all-time highs. What we also saw was that the CAF index, small cap quality, was actually far better today than the Russell 2000. You can see the Russell was down 1.1%. The CAF index, or small cap quality essentially, was down 0.36%. So bigger upside moves, smaller downside moves. But I think what the market is really doing is positioning themselves ahead of what is going to be a volatile week in earnings, FOMC, QRA, the NFP. And that's why we saw the price action we did here today. I mean, we go on the S&P 500, look at the 5-minute chart. This is the 5-minute chart right here. It's very obvious to see neither the bulls nor the bears won. It was just a flat day where, if you bought the dips, sold the rips, you really did win. Very positive gamma price action, even though we are still in negative gamma nonetheless. So there wasn't any winners today. What we did see was a bit of sector rotation. We did see a continued sector rotation out of tech names and into the rest of the market, but it wasn't so much tech as it was Nvidia and Broadcom, and then a rotation into the rest of the market. But all in all, it does look like the S&P 500 is putting sort of like this bottom in right here. that is a good thing. I mean, as long as we can hold this 5400 area, I mean, that literally just opens upside from here. It's very similar to the IWM. As long as you could just hold this 217 area right here, that literally opens upside levels to all-time highs. But I think in a week like this week, that's very data driven and earnings driven, I think you are really going to see a flight back into the bigger names, especially after they've come down 10% on a peak to trough basis. And that's kind of the dynamic you're seeing today. The Russell has run up 15% in the last 3 weeks. The Nasdaq 100 is down 10% in the last 3 weeks. That's why we saw a little bit of Nasdaq outperformance relative to the IWM. The IWM giving some back, the Nasdaq 100 gaining some, having that flight to quality in what is going to be a very volatile week, particularly from tomorrow onwards. But we did see constructive price action in stuff like yields. The 10-year yield actually fell on the day, down 0.43%. The 2-year yield was slightly up, but that's to be expected. That's kind of the price action we've been seeing in the last couple of days. The 30-year yield also fell here on the day, down 0.63%. Bonds gained. The AGG was up 0.16%. TLT was up 0.5%, still tangled at that $94 area. The dollar was very volatile and very firm today. Gold, silver were flat on the day, and then crude continues this huge move down all the way down to the $75 region. And that's exactly what we said. We've been saying all year that the $70 to $90 region is probably what oil is going to trade in for the rest of the year. So we could probably go to as low as the 73 area, maybe even the $70 area, and as high as the $90 area. This is probably the range that we're going to trade in for the rest of the year. I don't think we're going to see any bigger moves to the upside or downside, because the Saudis will cap downside and the US with the SPR will probably cap upside from here. As a result, the S&P 500 was flat, up 0.08%. The best performing asset was the Nasdaq 100, up 0.19%. The IWM fell 1.1%. The equal weight gained slightly, up 0.14%. And then mid caps fell and SP 600 fell, although a lot less than what the IWM did. Now that does leave us to what comes next for the S&P 500. And if we just pull up something like the gamma chart, and we had some major changes, I guess you could say. Now the core resistance is still here at the 5750 area. However, what we did see is a couple of other movements in stuff like the gamma flip zone. It actually did move down from the 55.55 area to the 55.25 area right here. And then 5300, the put support actually moved down from the 5400 area to the 5300 area. This is often a bearish indicator, but if the market goes ahead and actually takes the gamma flip zone, that's not going to matter. Then we would look to the upside target of the core resistance. But if this stays at 5300 and we continue to see price action below the gamma flip, our target is the put support here at 5300. Now the 5300 strike and the 5400 strike are very closely built together. So we're going to see how that actually moves for the rest of the week. Will the put support move back up to the 5400 strike? Will it be at the 5300 strike? That's something yet to be seen. But if it does move between the two, you can definitely bet your socks that what the S&P 500 is going to do is just trade flat ahead of a week with wild uncertainty. So these are the key levels we want to look to. As long as we're below the gamma flip zone, ideally we're looking to the put support 5300, maybe 5400 as our downside targets. The second we get above this gamma flip zone, and these levels are dynamic, they change every single day, guys, we are then looking to the 5750 area where we will buy dips, sell rips. We also do have to pay attention to seasonality. We are going into August, and I talk about it a little later on in this video, that we are in a counter trend month in August. When we've had a positive year and a positive May to July, August tends to be negative, and we could actually see some of that volatility make its way into September and October, because in a typical election year, September and October tend to be red. So we could actually be in a period where we see maybe not necessarily downward correction territory, but generally like sideways price action in the S&P 500. And by sideways, I mean like we could go like all the way back to like 5700. We could just trade sideways in this range for the next 3 months. We could definitely do that given seasonality and where the gamma chart is sitting right now. But you know the go. We're buying dips, selling rips above this area right here, and we're selling into weakness, buying into strength below. And our obvious targets are 5300 with support, 5750 for gamma resistance. Looking at sentiment, this is BOFA's bull bear indicator, and we saw a huge increase last week from the week prior. in the context of the Nasdaq 100 and the S&P 500 being down last week, and this just goes to show the composition of the indicators and what's happening beneath the surface of the market. Now, a lot of these sentiment indicators, in fact, all of them include a market momentum, a market strength, and or a market breadth indicator. And with market breadth improving significantly in the last week and a half, 2 weeks, we are seeing these indicators improve significantly as well, while the Magnificent Seven, the bigger boys, these growth stocks, take it on the chin, relatively speaking, to something like the IWM. And what we are seeing now is some of these indicators getting to frothy levels. I think anything above 7 gets a bit frothy. The sell zone is right here at the 8. So if market momentum continues, if breadth continues to improve, we should see the shoot to the 7 to the 8 level pretty quickly. And that's when we could see some real near-term volatility. This might even get to like the 7.5 level next week if the Russell continues to rally, good NFP numbers, and we get like a dovish FOMC. That could very well be the case. However, market sentiment is clearly ticking up and improving, but it's not just because of market breadth, also because of rate cuts. Right now, priced into the market is 69 basis points worth of cuts. Just to put it into context, at 75 basis points, that's 325 basis points worth of cuts. Essentially, what the market is pricing in right now is 2 cuts worth 25 basis points and then 1 cut of 20 basis points. So the market is getting a bit frothy here with the rate cuts, but that's generally how it goes. The market never trades in equilibrium. It shoots to the upside and the downside the same way human emotions do. And with rate cuts on the horizon, firm disinflation underway, and earnings growing, this is often the sweet spot for equities. In times like these, when inflation is 2 to 3% and earnings are growing, we often see equities return 14% 12 months later. It's actually the best environment to be in, whereas 0 to 2% inflation environments at 11% annual returns and then 8% here in high inflation environments. So we are in the equity sweet spot. That's why equities are rallying, especially when we do get accelerating earnings into the end of 2024, topping out at 14.7%. And any type of near-term volatility that we do get into the market should just be viewed as an opportunity, because the market drawdown right now is relatively low to history, especially in the second year of a bull market. In the second year of a bull market, we average a drawdown of 9.4%. Right now in 2024, we're sitting at 5.5%. So we can actually see a bigger drawdown in the S&P 500, and any near-term volatility should just be seen as an opportunity to get long for the eventual rebound. And we could actually see that near-term volatility rear its head in August. After a positive May to July, August tends to return negative 0.57%, negative 0.65%, 20 wins, 26 losses. That's a really bad hit rate. By the way, on average, we see hit rates something like 30 wins, 4 losses, something like that. So to see that type of hit rate really goes to show that when we've had a positive year, particularly a positive May to July, we do see that counter trend month come in August. And in a typical election year, we can actually see that volatility continue into September and October. We are about to head into the biggest earnings week for the second quarter here in 2024. 34% of S&P 500 companies are reporting this week. We have companies like AMD, Microsoft, Amazon, Intel, Apple, Meta, ARM, Wingstop, Qualcomm, Carvana, Lam Research, PayPal, Pfizer, BP, PG, McDonald's, Philips. They're all reporting this week. A huge week of earnings coupled with FOMC is definitely going to bring the volatility, but earnings volatility is something we haven't really seen. Sure, one-day reactions have actually been quite negative. If you miss both on EPS and sales, we saw negative 2.2% in return. However, 5 days later, you've pared all of those losses and some, seeing a 2% return in total. In fact, in almost every single category, excluding an EPS miss, in every other category, 5 days later, returns were positive. However, all of this could literally change this week with the volume and market cap of S&P 500 companies reporting this week. We cover S&P 500 earnings almost every day in the thick of earnings season, but what about global earnings? The global earnings revisions ratio for the 1 month actually fell from 0.95 to 0.85, so we're seeing near-term volatility in earnings. However, the 3-month ratio improved to 0.87, above the average earnings ratio. That is a good thing. So as we're seeing S&P 500 report great earnings, we are seeing the same trend in global earnings. And what we are seeing is a global rally in sector, size, and geography, driven by earnings growth, easier monetary policy, and rate cuts. And even though EPS is expected to be exceptional in 2024-2025, EPS becomes less relevant when the Fed cuts rates. Why? Because disinflation influences lower rates and yields because real yields rise, stimulating greater M2 and liquidity, expanding multiples. This means the S&P 500 goes up. When the Fed cuts rates, we see earnings normally go down, but PEs expand more than those earnings go down, simply because there's more liquidity, more money in the system. Net, the S&P 500 normally returns a smidge under 15% 12 months later. So let's say the Fed cuts, even if earnings do go down, expect higher prices in the S&P 500. And let's say S&P 500 earnings come in as expected, the S&P 500 can go to heights that would make some of Wall Street's biggest bulls look neutral at best. Let's look at some economic data. This is Fed's GDP Now, an indicator we look at every week, multiple times a week. And right now, the Fed's GDP Now is sitting just under the 3% mark, probably 2.9%, well above the blue chip consensus, which is sitting at about 1.8%. Now, the reason why I like the Fed's GDP Now is because it was the most accurate forecast of the most recent GDP print leading up into it, predicting about 2.8% in GDP the day before, even up to the week before, and that's what GDP came in. Now, the blue chip consensus always tends to be a bit conservative, and it's no surprise as to why these investment banks and research houses are coming in conservative, because economic data has been quite the dumpster fire here in 2024, pretty much making lower highs and lower lows on this chart. However, we have seen the data froth out, but this right here is still fairly weak data, because anything above the zero line right here is better than expected economic data. Anything below is worse than expected economic data. So we are yet to see this improve, but the one thing that's kept this economy rolling has been non-farm payrolls. In the last 5 prints, we've only had one data print that's actually missed the forecast. Every single other one has beaten the forecast handily. Look at March. The actual came in at 275,000. The forecast was 198. Look at the most recent print here in July. 206,000. The forecast was 191. And now here in August, the forecast is 177. And we are getting the NFP numbers at the end of this week. Now, the consensus estimate is actually around about 175, 177,000. But BOFA is a little bit more upbeat on their estimate. They're actually expecting 225,000. They're expecting non-farms to come in a lot better than expected. The unemployment rate to stay steady at 4.1 though. Private payrolls to also beat at 180,000 versus the consensus. And then average hourly earnings, average weekly hours to come in at 0.3, 34.3. So essentially what we're going to see is more people employed, but wage inflation to remain steady and the unemployment rate to also remain steady. So if we are to get BOFA's numbers, I think that's actually going to be a rather good thing, because we do know that disinflation is well underway and the consumer is also looking rather healthy. This is total online retail card spending per household, tracking well above 2023, the consumer looking robust, the labor market looking robust, and growth looking robust too. If you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.